Good evening. The presentation of the economy, markets, and our ongoing NFO, which is the Sundaram Bluechip Fund. I am sharing my screen with you, and as you can see there, size matters is the code of our fund, and this is going to be an open-ended equity scheme investing in large cap stock. It's a diversified portfolio, and the image of a sumo wrestler is our brand image for this fund. I shall explain the logic behind it at the end of my presentation. So, what are the characteristics of large caps, right? So, large caps are defined by SEBI as the top 100 companies by market cap in India, right? So, they carry the following non-stock market related features, which are proven business models, size. Their size obviously matters both in terms of scale and in terms of the competitive advantage it gives them. They get stability across business cycles, and they have wide and deep management bandwidth. Unlike smaller cap companies which are dependent on the owner or the owner's family, they have much more wider depth, and they also have strong balance sheets which help them to acquire good quality people as well as growth through M&A, buying out companies. And then when you come to the stock market, right, there's high liquidity in these stocks and the universe is well researched. So there are absence of too many surprises in terms of what happens with those companies, right? So as we move forward, right, like I mentioned earlier to you, this is a diversified portfolio. So it will have about 45 to 50 stocks. Now within large cap, there are concentrated large cap funds which are limited to 30 stocks, and there are diversified which have 45 to 50 stocks. This features in the diversified list. Hence, its benchmark is the NSE 100 because you have a wider range of 100 stocks from which to choose from for most of the portfolio. Regulations permit a max of 20% on mid-cap stocks. And on the portfolio construction, I shall talk to it a bit later. I have spoken enough about large caps as a sector using the indices. Now I want to move to the fund management side, where why is a fund manager expected to deliver better returns than index? Because stock picking matters even in large caps. What do I mean by that? That if you put 100 rupees in the Nifty 100 in 2009, in 10 years it has grown to 240. But there are out of the 100 stocks in the Nifty 100, there are 46 stocks which have consistently been in the index. That means that quality has been such that their market cap is been in the top 100, right? Balance 54, sometimes inside, sometimes outside. So these 46, if a good fund manager had picked them, you would have got for your 100 rupees 289, which is 49 rupees more, which means 49 divided by 100, 49% more absolute return, right? So that's why stock picking matters and why a fund manager is expected to deliver, right? Which are the kind of companies those stocks are? And few are given here, all are household names, right? And so Sundaram, in this fund, how are we going to do stock picking? Through our own diligent and disciplined investment process that is laid out here. And for this, we have chosen what is called as a blue chip quality framework. What is that? It's a non-stock market framework. It is based on the business. So first, what does it say? It is management quality. It is capable, credible management with strong corporate governance. One. Second, business model quality. What is that? Strong competitive positioning and strong competitive advantage. Process and system which come with scale and size, because most small cap and mid caps are owner driven. So they don't have the systems and processes to do. And then a brand value which has seen many business cycles, so that the company knows how to handle a bad time, how to handle a good time. And then on financial quality, we talk about attractive return on equities, we talk about cash profits and not paper profits, and we talk about company reinvesting that cash into the business so that they borrow less. So the healthy balance sheet means that their debt equity ratio is very healthy, low debt, high equity. So these are the three blue chip qualities. Now, these three blue chip qualities are non-stock market. Does the stock market respect this blue chip quality at all? Because you may say good company, but is it good from a market perspective? So what I did here, what we have done is that there are 35 large cap funds in the industry. Only 7 have chosen to name themselves as blue chip funds. Now I accept that Sundaram's idea of blue chip fund and another AMC's idea of blue chip fund could be very different. But both of us, you have to agree, is that by naming it blue chip, we are seeking to have a quality portfolio. The way they define quality may be different from the way I define quality. But ultimately, quality is our aim. So I have now looked at those 7 funds and seen their returns, which is what I call the blue chip category average. Then I've taken the whole large cap category average and I've taken the BSE 100 average. And if you can see that these funds collectively have beaten the blue chip the category average and have beaten the index. Which means what? The conclusion I want to drive from this is that the stock market respects quality. Right? So whatever be the filter you use, the chances are likely that that quality filter will lead the market to respect it and give you better returns. So that's the blue chip thing that I spoke about. And if you look at our funds, right, we have also got certain long-term picks. I've picked those picks in the overall portfolio of a fund, which have been in the fund or one specific fund I've chosen. At least for 4 years, they have remained in the fund. So they are long-term. And I've taken a 5.5-year period from March 2015. So you can see that the weightages of these, what is the beginning and what is the end. In most cases, we have increased the weightages. And if you see that these stocks, 4 of the 8 stocks are given strong double-digit returns. 3 of them are given high single-digit returns. Only one of them is LNT, because it's an industrial pick, which is the business cyclicality affects it, is given a slightly negative return. So this is the way Sundaram Mutual has picked stocks in one of our funds, right? And I want to now take you through 3 case studies of stocks we bought, which are blue chips. And I want to tell you how we will select blue chips. And they are currently in our fund. So, Tata Consumer Products, a result of a merger of Tata Tea, Tata Salt, Tata Coffee, a mega Tata brand company, carries the strength of the Tata brand and is a huge player in multiple consumer spaces, right? So such a company, we bought it in 2017. And if you see, its sales went from 6,700 crores to 10,700 crores, and next year is expected to be 11,500. In that period, his EPS has gone from 6 to 8. Next year is expected to be double at 12. So such a company, right? Because it's a blue chip, right? Its PE ratio is high. So look at it, 90. But what is the PE? I spoke about it a few minutes ago, right? The PE comes from a demand for the stock, which means it's very attractive for people to buy, but also an expectation of future earnings. Now we started at a PE of 90. Today it's a PE of 66. What does that tell you? That the concerned company has consistently beaten the return expectation of the market analysts and deliver better. That's why the PE has come down. So next year is down to 47. So that's why I said even at a high PE. So blue chips are high PE for your information, but as long as you pick the right company which is going to deliver better than expectations, you can see that since the day we invested, the Nifty 100 has gone up by 7.1% per annum, but this stock has gone up 42.6% per annum. Right? So rest my case on this company. Next is Bharti Airtel. Slightly controversial because Jio is fighting with it. Who will win the race is a big question mark and all of that. But please remember one thing. But he is a survivor, he's a dedicated telecom player, and thanks to the butchery of the rest of the industry, it's now become effectively a duopoly. There's a third Vodafone in the anvil, but it's effectively a duopoly, and India is a large and probably the fastest growing market in the world. So as a duopoly, both the companies will benefit from this advantage, and such a company, it has been through its ups and downs in terms of revenues and EBITDA, but if you look at its EBITDA margin, yes, maintained that solidly at 56 to 40%, right? So that kind of a company, by buying it, we have enjoyed a 17.9% per annum return as compared to the index of 7.1, and we feel that the coming days of this company are going to be even better. That's why the ratios are still high, right? The third case study I want to showcase to you, friends, is SBI Life Insurance. Strong brand parentage of SBI, unparalleled bank network of 20,000 branches, already the largest private player having 23% share, and is the next LIC in the making. Such a company, we bought it in 2017, has doubled its enterprise value to substitute for sales, right? From 190 to 402 expected next year. Its EPS has gone from 11.5 to 19, expected to go to double next year. And it's again another company where the PE ratio was 75 when you bought it. But again, now from 75 it has come to 43 and headed to 37, means that company has consistently beaten the analyst's expectation of earnings, and hence such a company has delivered triple the return of the index. Index has delivered 3.6. This company has delivered 10.1% to our portfolio per annum. So those three case studies hopefully have shown you the way we will choosing the blue chips in our portfolio. And if you look at it from a sector perspective, I spoke a lot on the stocks. The sector, we are going to be sector agnostic. And if you see from 2007 to now, and you look at the red being the negative sectors, the green the positive, the leadership has kept changing. So no point in keeping a very permanent sectoral approach. Constant flexibility is needed. In fact, over the last 3 years, as a company, our sector calls, you see, have changed year over year on the overweights and the underweights in the industry. So sector, we have to be agnostic, be smart and ready to change. And now I just quickly take you to the fact of Sundaram's large cap track record in terms of the funds being going to be managed by the fund manager of this fund, who's our primarily large cap fund manager. The 4 funds that he manages in the open-ended space all carry in the first green table 58 to 90% large caps. So he is an experienced large cap fund manager. Select Focus is one of the funds he manages, but since it's also large cap, it's my duty to explain what's different from Focus to Blue Chip. Focus is a concentrated large cap with 30 stocks. Blue Chips has 45 to 50 stocks. The other aspects of it, I will tell you, is that the concentration within the 30 is very high, with top 10 stocks forming 60%, whereas here top 10 will be 40 to 45%. Second is vis-a-vis the benchmark, which is Nifty 50. He takes quite a few high conviction bets in Focus, but here he will not take such a wide range. He will be closer to the benchmark in terms of that. So if you see here, those same points I wanted to demonstrate to you is that his top 10 stocks have been consistent since the April to June quarter 2018, and SEBI categorized large cap funds has been consistently in the 55 to 65, 10 stocks. In fact, 3 stocks have been 27%. So Focus is a high conviction, super concentration, super flexible fund, whereas, right, and the overlap also, if you see, sector-wise, he has maintained in the middle a high 80% overlap with the benchmark sectors, but in the stock, he's maintained only a 60% overlap. Means 40% of the stock by weight he has chosen from outside of the benchmark, right? So that will not be the case in this fund because it's a diversified fund. He also manages a diversified large cap fund. Just in case you said, oh, he's good at managing concentrated, does he manage diversified? Yes. In the equity hybrid, the old balanced fund, he has a 75% large cap of the equity portfolio, and he has 48 stocks, right? And the top 10 stocks are just 45%, very close to what the blue chip fund is likely to have, right? The final fund of Rahul Bajaj that I want to tell you is the new NFO 2 years back that he launched, the services fund, which has also got 59% large caps. And if you see that, he deployed the money in the second half of that year gradually over a period. So to the extent that the regulations allow, he will do the same in this fund to stagger the deployment, because in the next few months, we expect the market to remain volatile because of the US elections. The table, the slide here shows you right from the 2000 elections. The 3 months before the elections, markets have corrected, the US stock market, because people have pulled their money out of equities. And same thing, FIIs in India and other emerging countries will also be trying to pull their money out in this period. But 3 months, 6 months after, it bounces back. So that given that volatility which will come to our market, because not just this, the rural COVID case rise I spoke about, and put together, we expect a volatile period. So we will stagger the deployment within the regulations to the extent possible to maximize, because he will be sitting with the most powerful thing in the world, cash on hand from the NFO collections. So that, to summarize the fund, dear friends, is that it's going to be a diversified, the bedrock of the fund is that diversified in terms of number of stocks, concentration, risk, all of that. Blue chip quality framework, and it will be a blend of growth and value. So it's not just going to be just high P ratio growth oriented stocks, but he will also pick value stocks which will come in from the sectoral allocation, because as you know, certain sectors are expected to be later recovery and certain other sectors. So he will play the value game there till the value is reached and changed it over. So the blend of growth and value will help him to reduce the risk of the portfolio, which is the purpose of a diversified large cap fund. So to summarize, right, this is the advertisement campaign based on a sumo wrestler. And the reason we chose a sumo, let me explain to you in 30 seconds. Right. So a sumo wrestler is big in size. So size matters comes through. But I could have chosen an elephant to show big in size. No. Why did you choose a sumo wrestler? Because in sumo wrestling, you have two big people trying to push each other off. Right. So the first thing is, as this picture demonstrates, that sumo wrestler has to have the stability, a low center of gravity to take the pushback from the opponent. So one category or characteristic of blue chip large caps is their stability across business cycles, which point comes through by the choice of a sumo wrestler. The second aspect is, if you have seen a sumo wrestling competition, or if you can see the video which comes on television and the YouTube and all other channels, right? You will observe in the course of that wrestling competition that we have used for presenting our fund is that one wrestler has to turn the other big wrestler down and push him down. He can do that only and only if he has got agility and flexibility on his side, which is another characteristic of blue chip large cap stocks. So we feel that a sumo wrestler represents all the three: size, stability, flexibility in one image, which effectively portrays what these stocks in our fund are going to demonstrate and going to be the reason for it to deliver the goal of capital appreciation with lesser volatility. Right? So to summarize, it's an open-ended scheme investing in large caps. Nifty 100 is the benchmark. Rahul Bajal is the main fund manager. And like all equity funds, it has a 1-year exit load with a minimum investment of just 100 rupees. SIPs are also available. Thank you very much for listening to this presentation. And I'm happy to take any questions if there are around the fund or around any of the other things that I discussed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.